All right. Well, good morning, everybody. Thank you so much for joining us today. So this is our November sales meeting. And yeah, that's a picture of us right there. Hopefully not. Hopefully we're a little bit more energized and yeah. And not necessarily sleeping our way through. So I've got a lot of cool things to share with you. As soon as the meeting is over, I will send all the slides for these PowerPoints over to all the branch managers. So all the branch managers will have all the slides and the PowerPoints. You can share those out. Please feel free to rip off and duplicate as much as you want. I pulled up a ton of information that should be very, very helpful for everyone moving forward. At least I hope it is. So because there's a lot of uncertainty and kind of angst going on in our market right now. And we have a ghost here in the McDonough office. So, but you know, our format is kind of the same as it's been for the last several months. You know, I'm kind of going to be going over, you know, a lot of market stats, kind of what's happening in the markets, and a lot of things we have going on. And then we're going to switch into the local mode where we kind of break down exactly what's going to be going on. And then I've got a couple of tasks for all the lenders to kind of be talking about and sharing today. So with no further ado, I kind of want to run into it here today. So, that clicker's working, I guess. There we go. So we start off today with today's voting day. And so if you haven't voted, please, after attending the sales meeting, go vote. I don't care who you vote for, but it's civic duty, go vote. So, you know, now I also pulled up some other interesting information, which I found was really unique for, you know, about the political world. But the first thing is I want to kind of beg you not to go crazy political. You know, real estate and politics don't mix really, really well. And I'm not, you know, we're all independent contractors. Everybody can run their business any way that they choose to see fit. That being said, we're a very polarized nation. We have about half the folks that lean conservative, half the folks that lean liberal, and folks are very much, you know, folks will politicize things in nearly every election cycle, especially every presidential election cycle. We end up with agents that lose business because, you know, folks like, well, I didn't know you were a Democrat, or I didn't know you're some crazy Trump Republican. Like these kind of things happen every single time. And so, you know, I'm going to kind of beg and implore you to be wise about what you're sharing and what you're posting. So, you know, for me personally, yes, I have my thoughts and beliefs, but those are mine. You know, I would much rather talk about real estate with you. My political beliefs have no, you know, like it doesn't affect how I do my job. You know, and I have found it is unwise to share politically out there because people will judge you. I'm not saying it's right or wrong. I'm just saying it is. Like if I came up here and put a MAGA hat on, some of you guys would judge me. If I came up here and I put you know, a Biden hat on, some of y'all would judge me. And it goes the exact same way. And so I don't want to be judged based on any kind of political opinions. And I don't think you do either, because it can affect your business. So don't talk politics, talk houses. So that being said, one thing I found was very interesting is many Americans are hesitant to live among people that have different political views. I find this sad, actually, a little bit, that we can't have like just normal common discourse kind of thing. Almost half of the folks said they'd be hesitant out there moving to an area that didn't have similar political views. And really, I highlight that just to point out exactly what I was saying. Like if they don't want to live next to somebody, they don't want to work with someone that doesn't have the same political views. So just don't go there, kind of thing. You know, affordability, crime are top of mind for Americans deciding where to live. See, now these, and I'm not, again, I'm not here to be political. I'm not talking about the political landscape. I'm talking about, you know, for the folks about deciding where to live, affordability, crime are big deals for us. Housing affordability is really, really important. And I mean, it's much more of the national political conversation right now. It's even a lot more of a local political conversation. And so we can see that, you know, is housing affordability impacted you? Is it important to you? And I think everyone is, because one of the biggest, you know, drivers of inflation is housing, whether we're talking mortgage rates or we're talking rental rates, that kind of stuff. You know, over half of Americans support policies to keep homes affordable. And I think that's a really good thing. However, we have to be really careful about what that really means. And let me like, first of all, does anybody know, how does the government view housing affordability? Cost. They just look at bottom affordability, and for them, the vast majority of housing affordability comes in the form of rentals. And for me, rentals are like as an investor, I think rentals are great. But you know, wealth in the United States is tied up in home ownership. So do I want the investor to be the producer of wealth, or do I want the homeowner to be the producer of wealth? I would much rather that we're creating, you know, strong communities and people that own their own homes, kind of thing. That being said, single family home starts fell to its lowest level in 2 years. And so while single family has collapsed, double-digit rent increases have kind of gone on. And what we're seeing is that multi-unit apartments, basically, apartment construction is continuing to double. And so I want you to see how that is like on the surface of it, we all have to agree that like housing affordability is really, really important. I think housing affordability is crucial. That being said, if we're talking about, hey, I want to go turn people into renters, I don't see that as a place that really helps Americans out. That's not a place where we help people grow. You know, when we look back at something as evil as redlining was, I mean, why was redlining so evil? Because it stopped people from owning homes. And when it stopped people from owning homes, it stopped that wealth creation. And so that's really, really important. And if we switch to a society that is heavy on rent and not heavy on ownership, we're going to do that exact same thing again. And so I don't want to see us kind of going down that road. This is what's happened to median asking rents since 1988. All right. And so like when you rent, you have no equity, right? And so, you know, again, you know, renting is not a safe haven. That being said, you know, this is our rent growth for you can see for the past 12 months. And so, you know, overall here in Atlanta, we run about 7.5%. Georgia's run about 5%. That's on top of 17% last year. That's on top of 4% the year before, 7% the year before that. So rents have been really, really steadily increasing, especially when COVID first came out, it kind of froze there for a little bit. But then it's because rental rates are based on property values, and so property values have increased. Now, here's the challenge, and I think we have to be very, very conscious of it, that here in the Atlanta metro area, is it cheaper to rent or cheaper to buy now? Now they're really, really very, very similar. I mean, but for the last, gosh, I want to say for the last 10 years, it's been clearly, it was, you know, it's not this way in every market, but in our market, it has always been cheaper to buy than it's been able to rent. And so we have tipped over to a point where there's a meeting that's happening right there. And so, you know, and so I think we have to be very conscious of everything happening inside the economy, what's happening in housing, and we're going to be looking at those numbers a little bit more. But I want to make sure that like what I'm not here to do is to blow smoke up anybody's skirt. I'm not here to tell renters, look, it's cheaper to buy. It's not. They're about the same right now. But that being said, there are still some amazing reasons to be a homeowner, kind of thing. So this is the gap in wealth between renters and homeowners for the last 12 years. So in 2010, the average homeowner or the average renter, their net worth was $6,000. The average homeowner, their net worth was $200,000. And in 2019, the average renter's net worth was $6,270, and the average homeowner was $254,000. This is where we stand right now. The average renter's net worth is $6,270. The average homeowner is $254,000 or $255,000 roughly. So do we want our friends, do we want the folks, our clients to be part of the group that has the net worth of $6,000 or has the net worth of $250,000? Because it doesn't happen if you don't enter the game. Like if you're not a homeowner, like this is one of those that is please steal this one, post this one everywhere. I think that these are really, really important slides to show because this is real data here that's consistent. And it's very easy when things are, like right now we're in a very politicized time on top of it. And then the economy is kind of doing all kinds of crazy things and the housing market's doing all these different things. And so any times of uncertainty, people tend to withdraw back into their shell. And so we need to make sure that we're sharing the information that's really, really important. Does anybody know when the best time to buy is?
5 years ago.
Always 5 years ago. No, seriously, like, is there any time that you haven't looked back and said, man, I wish I bought 5 years ago? Everyone says that I wish I'd bought 5 years ago. But that's really, really true. It really does move forward. Largely because equity is kind of like the shining star for real estate. Homeowners have an average of $320,000 in inflation-adjusted equity in their homes. That's just the average out there in the U.S. So we have a lot of wealth tied up in home ownership. How much do our renters have? $6,000. Well, they have none in home ownership, right? And so these are homeowner equity gains. And so, right now here in Georgia, our equity gain in the last year was $65,000. Now, I'm not going to purport to tell you that is a normal year. Normally, property values increase on 4.4% on an annualized basis. That being said, the last couple of years has been really, really strong, but still the average for the last 50 years is 4.4%. And so for a lot of households, and I do mean for a lot of American households kind of thing, home equity is their only source of wealth creation. And I say that not to humble or belittle anybody, but for a lot of Americans, they don't have very much in savings. They don't have stocks. They don't have bonds. They don't have investments. So their home is their piggy bank. It is their source of wealth. And so we need to realize that. And also we should be sharing that, right? Like for so many, I know so many friends that don't have any savings, but their home is worth a lot more than it was when, previously kind of thing. They've got a lot of equity built up, and there's a lot of confidence that comes in having that level of equity built up. Not only that, especially if you have a fixed income, a fixed mortgage, how much, even though your property taxes may go up, has your mortgage payments gone up? So homeownership is a hedge against inflation when it comes to that. So this is the percentage and change of property values since 1990, 1991. Since 1991, the national average is 290% property value growth. In Georgia, it's 282%. At the same time, how about our renters? 0. Y'all follow me? So even though I know that, yes, renting and buying may be very, very similar on the monthly payment, what's their long-term prognosis really going to look like? Very, very different, right? Your net worth is really going to be hugely affected by that. So the question that we have to ask ourselves or our clients, and I say this because the reason I want to say that you have to ask yourself is I've had several conversations with agents lately, and they're like, I'm just not sure I could recommend that now is the right time to buy. I don't know if am I doing my clients service saying you should buy right now. And believe me, I totally understand, but I think some of the things I want to show you today are some of the numbers and what we're really looking at. And even though I know it's tougher, it's especially tougher for our first-time buyers. I think our first-time buyers have it tougher than anybody. For our move-up buyers, they've at least captured that equity already, and they're carrying that forward. But our first-time buyers, I know it's tough. And I don't dispute that one bit, but do you want to stay a renter for forever? Or do you want to move into do you want to be part of that group whose net average, net worth is around $250,000? There's a big difference right there. At the same time, we have first-time home buyers. I said first-time home buyers have it really, really tough right now. Look at the first-time home buyer percentage that we have right now. It's the lowest we've ever had. Now, what is really, really ironic, at the same time, who's the largest population group that we have in the United States? Millennials. And over the next 4 years, the largest population group we have are all between 28 and 32 years old. And the first-time homebuyer age is 33. So over the next 4 years, largest population group we have will be reaching first-time homebuyer age. However, our first-time homebuyer percentage is at its lowest ever. So a couple of points. One, we have a lot of demand built in, right? There is a ton of demand. We already have a shortage of housing. We're not building enough housing. And we have a huge population group that wants to get that housing. So we have to be more creative, but we also have to be able to speak truth to folks about what's really going on out there. So, and the mortgage rates are the kicker. That's what's kicking us, square in the teeth right now. The mortgage rate increase since the beginning of this year has impacted affordability about 35%. And this is the challenge for our market right here. So basically, a home that was worth if you can afford a $300,000 home in January, you can afford a $200,000 home right now for the same payment. Is that easy to take? No, it isn't. I know so many folks. I mean, we don't have to go back and say, I wish I had bought 5 years ago. And you say, I wish we had bought in January or February this year, kind of thing. I still remember how many people were talking to us this time last year saying, I just don't know. I'm going to wait for rates to go lower. I'm just going to wait, things like that. So, but that being said, this is where we're at right now. So this is what's happened from the beginning of the year to where we're at right now. We actually came in last week at a 6.96, but interest rates are probably going to be fluctuating in that high 6 to mid 7 range, for the next several months. I really do see it kind of sitting there for a while. I do think that we are going to, the holiday season will be a little bit depressed. And I think that will kind of drive the Fed to back off a little bit, which will also help rates in moving into next year, kind of thing. So we have mortgage rates that have doubled in the past year. I don't say this just to kind of like keep pouring salt on the wounds, but like it's worthwhile to acknowledge that this is our challenge. This is our challenge for our buyers right now. This is what's affecting everything in real estate. This is also affecting sellers. Do I sell when I've got a 3.5% rate and I have to go buy at a 7% rate? Well, I'll just stay here. I'll do a cash out refi. I'll do a HELOC loan, those kind of things. So it's impacting us. That being said, if you're old and crusty like me, like these rates, while we go, oh my gosh, 7 is unbelievable. Like my parents bought at like 13 and a quarter. I think one of Ming and mine's first mortgages was like 9. And when you're at 9, 7 looks like a dream, so we have seen interest rates dropping over the last several years, but when you kind of put it together, we're really at kind of historical. I mean, we're at like an average right now. As weird as that sounds, it's just that no one's used to that average. We all have knee-jerk reaction of, I wish it was January, I wish it was February, kind of thing. And not that helps us any, but we do have to look at this long term for what's really happening. So we are looking at mortgage rates are probably going to drift a little bit higher moving into the end of the year. I think we have to be ready for that. I don't think there's any, I don't see any reason for relief to be in sight. Now, the federal funds rate does not directly affect mortgage rates. The 10-year treasury is what mortgage rates follow. But every time that the Fed raises their rates, it makes the markets kind of go nuts. And when the markets go nuts, investors move money over into safer investments, say treasuries, say 10-year treasuries. When more people invest in 10-year treasuries, what do you think happens to those rates? They go up. When those rates go up, mortgage securities go up also. So, that's kind of what we're heading into for there. So no doubt that the rising interest rates make our mortgages, the mortgages make home buying really, really tough. However, we're moving into a time of year where we have more inventory than we've had in the past. We don't have more new inventory, but we do have more inventory. We'll look at that in a second. We also have the time of year where we're seeing more opportunities for bargaining, for, we have more sellers that are open to negotiating, to looking at different deals than we have seen for probably 3 years now. Sellers are starting to realize, some of them are. We have more property, we have more price reductions, we have more opportunities when it comes to that as well right now. Now, Fannie Mae just released this and said that they expect mortgage rates to be at 4.5 by the end of 2023. I'm not sure we're going to be at 4.5. I do see it coming down, but I'm not sure. I'm with, and don't get me wrong, the talking heads at Fannie Mae are probably way smarter than me. I'm look, if we could get to 6, I'd be like ecstatic right now. And then if we can move, somewhere into 5s, that'd be even better. But I don't think we're ever going back to 3 personally. But do I see us moving back down into that 5-6 range? Yeah, we really do kind of need that. And I think that's one of the things that really does help to rebuild housing at that point. So what's a potential solution here? One thing I'm going to ask for all the lenders and all the offices today to do is to please go over the 3-2-1 buy down or the 2-1 buy down scenario in your offices in specifics kind of thing. I'm going to kind of go through this quickly because we're seeing where for those of us that have been in a business for a long time, back in my day, we did buy downs and it was a very normal course of business. And we've been talking about doing buy downs and new agents are like, is that legal? Can we do that? Like what is a 2-1 buy down? Can buyers buy down rates? Can sellers buy down rates? There's a lot of questions about that kind of thing. And so what a 2-1 buy down is for the first year, it gets bought down to a certain percentage, then it goes up to a percentage somewhere in between, and then it goes up to what the actual rate is on the 3rd year. And so we're seeing where sellers are offering it. We see where buyers are taking advantage of it, that kind of stuff. Because if like when we look at Fannie saying, Fannie says that mortgage rates are going to be in the 4s next year. If I could do a buy down for the first year or two and the market changes, then I can go out and refinance. And that's going to be a big deal. And I do think that, when rates come back, refis are going to be a really big deal at that point for that. But what I want to show you is actually how that kind of breaks down in like real world, because sometimes folks don't really understand and don't look at it. So, if you just look at, a house is listed for $500,000, they're going to put 5% down. So it's going to be a loan of $475. It's going to have, 6 and an 8.25 interest rate kind of thing. Their APR is 6.7. So they're going to have a monthly payment of $28.86. And that's just if it was bought straight out. Now, if the seller comes and does a price reduction, so they drop the price by $20,000. Well, that drops the overall monthly payment for that buyer by about $100, $110 a month. However, if you take that money and you do a seller paid buy down kind of thing, so the first year out, they get a 4.25. Second year, they get 5.25, and then it's the same rate for the remainder of the loan kind of thing. You can see that their first year payment is $2,300, which is a savings of almost $500 a month for the buyer. The second year, it's a savings of $200 a month over where it would be. And then it goes flat for the remaining years after that. However, if you look at what that costs, the cost to the seller was $10,000, less than the $20,000 discount that they would have taken if they were going to drop it just 5%. on that $500,000 house. Does that make sense? And so we're trying to talk to sellers and saying, listen, we can buy down the rates. We can offer closing costs or offer, let's offer $3,000, 3% towards closing costs plus buying down the rates, because that's going to be a real big deal for a lot of our borrowers, our buyers. So I'm asking all the lenders to please today talk to us in the offices about doing buy downs and that kind of thing, because I do see a light at the end of the tunnel on rates moving into a more moderate area. Over the next couple of years. It's not going to happen next month. It's not going to happen this quarter. Just accept that that's where it is. So, but for us, we have to decide: do I just take this on the chin? Oh well, business stinks. Just going to take it how it is, or am I going to be creative about trying to help folks move into home ownership? I rather than just give up, because a lot of times when the market shifts, people just oh well, I don't know what's going on. I can't really do anything about it. So, you got a question?
Yeah, I did. So if I was a buyer's agent and I was writing a purchase sale contract, how would I ask the seller to do the buy down in the contract?
Well, you're gonna have to work with the lender. So I'm gonna defer that until we have the lenders at the end, because I want them to answer those kind of specific questions in all the offices kind of thing. So here's the bottom line. I'm not trying to convince or talk anybody into selling or buying, right? But I do think that we have to look at realistic numbers and what the data is really saying out there. If you can have a house that meets your financial needs, that's good, then you need to be seriously considering it, because we're not looking at property values declining. So if you don't want to buy this house this year, well, you can buy this house next year and spend more for it, is really what we're heading into. And so I want to show you what those numbers really kind of look at. This is a quote: "In the absence of trustworthy, up-to-date information, real estate decisions are increasingly being driven out of fear, uncertainty, and doubt." And that's where I see a lot of our folks out there. And so what I'm begging you to kind of do is to be that voice of reason, to be talking about what's really happening in real estate, what you see going on. I'm not talking I'm like, am I going to go say, no, it's cheaper to buy than it is to rent? No, they're about the same. But there's still a lot of value out there, and we need to be talking about these kind of things moving forward. Because like before the meeting today, I pulled up real estate news. Look what showed up: housing crash worse than 2008. Housing market going bad from worse. Housing market worse than you think. Why the housing crisis isn't going away? Like that's just what popped up top of the news feeds. I didn't have to go looking for it. I didn't put anything in there. I just cut and pasted to show it out there. So if you have a buyer or a seller, is this scary? Yeah. Absolutely. Yeah. If you're thinking of buying and selling, this is terrifying, because you have no idea. It creates a lot of uncertainty. But understand that the news is not your friend. There's not going to be any kind of good news about real estate. So you have to be the ones that sharing real data, real information with them. And that's what I'm trying to give you guys. So now, the Fed, the aim of the Fed has been to fight inflation. They've been talking about fighting inflation, every month they raise that. And has it really cut inflation? No, but the whole idea is that it would slow down the economy enough to where it does that. Guess what? It's worked in real estate, right? Which I'm not real happy about, right? We still have high gas prices. We still have cost of food, cost of living. Those kind of things are still really elevated. However, what has the rise in interest rates done to housing? Exactly the desired effect that the Fed wanted. Now, I see that kind of carrying over into other industries and across the economy on a larger scale as well, because housing tends to react fairly quickly on that kind of stuff. So one thing that we have to look at, though, is that last year was not the benchmark. This is existing home sales. What did you see happen in 2021? Even if you look at 2020, from the minute that COVID, as soon as we could get out the house, housing started blowing up. We had 3 months we were shut down, nothing happened. And then what happened to housing? off the freaking chain, right? And so we're comparing numbers to when the market was nuts, when it was artificially driven by low interest rates, when it was artificially driven by very unique forces on our marketplace. So when we can also talk ourselves into being like, man, this market's terrible. We're down this percentage from last year. Well, last year was a nuts percentage already. You can kind of see where our historical average is. Our historical average is that we're down 1%. Is that a reason for us to go to the hills? Unbelievably terrible real estate market that we have? No, it isn't. So I pulled up all the data out of Georgia MLS and FMLS this morning. So I've got really current data right here. So this is our median sales price. And so you can kind of see the median, it looks like the median sale, sorry, kind of covered up the corner there, but it looks like the median sales price actually just kind of started to drop off a little bit. Not really, because these are seasonal trends. So like up here, this is what the median sales price was in October of 2020, 2021, and 2022. So you can see that we're still up 8% last month. Y'all remember what are our historical norms on property value increases? 4.4. So we're double where property value increases are right now. Just in last month. And so you can see that's FMLS, Georgia MLS, kind of the exact same thing. We're seeing where our median sales price is still heavily over prior year. And the reason that's an important number is when you talk to the average homeowner, the average person on the street, and you say, how do you judge if the real estate market is good or bad? Is my house worth less now than it was yesterday? That's how they judge it, right? I mean, they're not in the industry. Like, is my house worth less money, or is it worth more money? So for the average consumer, is their house worth more money? Yes. Yeah. Even and honestly, too much. I know it sounds bad, but we had 18% property value appreciation last year. Anybody that makes 18% more than they did the year before, well, or 10% the year before that. And this year we're running about 11% year to date. So those aren't really sustainable numbers. So seeing that property values are moving into a much more reasonable range forward, it's not a bad thing. I'd like us to be somewhere in that 2 to 4% over the next couple of years, or the next year or so. And that's a very healthy place for us to be. How about new listings? What's going on with new listings? Down big time. I mean, you would think that, gosh, like real estate's driven by supply versus demand, right? So we know that we got a lot of pent up demand that's being held back by interest rates. But what's happening to our supply side though? You would think, okay, we're going to really start jumping up on inventory, right? Inventory's down. Not just down from last year, down from the year before. We're down 17% on new listings. And by the way, same thing in Georgia MLS. So you can see we're down about 10% in new listings. Now, overall, as far as total inventory is moving up. So what we're seeing is it's kind of a picture of two different markets, right? When homes that come out of the market and they're priced right and they're ready to go, are they going fast? Absolutely. They really are. If it's priced right, it's in good location, good condition, they're moving quickly. But if they're not, if they're overpriced, if the sellers are saying, hey, we just want to try this price, what happens? They sit there. They collect dust. No one's going to do it. And so for a lot of sellers, it's very easy to judge sellers when you're not the seller. Everybody wants as much as they can get for their home. I completely understand that. But that being said, we also have to keep them understanding what reality is. And so it's not last summer where we could just stick anything up out there and people would fight over it. Now the homes have to be in the right condition. They have to be fixed up and looking nice. You can't just say, well, the Smiths down the street sold for $350. Well, the Smiths down the street had all new paint, granite countertops in the kitchen, well-maintained yard. You look like an REO property. The carpet looks like someone was murdered in the kitchen, living room kind of thing. So our housing supply is still historically low, okay? And so you can see that overall total inventory I mean, like, we are drastic, we still have a severe shortage of housing in the United States and in Georgia in particular, kind of thing. So not only that, so this is the total number of homes that we have on the market. Right. And so you can see since 1982, how many homes that we had on the market. Where do you see that at? See, here's the deal. Since 1982, we have a population that's grown by 40%. So we're not talking about, this shouldn't be on a straight scale here. Y'all follow me? Like 40 years ago, there was 40% less people. And that was how many homes we had on the market. Look how many homes we have on the market now. Real estate's driven by supply versus demand. Is real estate going bad? No, it's not. Even with the crazy interest rates we're fighting through. That was interesting. Everyone online, I'm sorry, I just kicked you on the floor. All right. So this is our total homes for sale. And so you can see that, right now in the FMLS area, we have about 19,000 homes. Gosh, in 2019, we had 27,000 homes for sale. Again, residential real estate is driven by supply versus demand. How about closed sales? We know that our sales are down, right? So, I mean, you can see exactly where we're at right now. Our closed sales are down. That being said, so especially what you're seeing out there on a lot of the news, like, do sales this time of year always drop off?
Yeah.
Yes, right. And so I think we're a little bit early, but if you look at it, like we're in fairly like seasonal, markets here. What's our average days on market? Has that been really drastically high? In FMLS, it's 15 days. In Georgia MLS, it's 10. Is our average days on market. Now that's not, it depends on the situation, that kind of stuff. But and we'll look at that. But our days on the market are still historically some of the lowest it's ever been. Like really, I mean, not maybe ever been, but you can see it is really, really low. Especially you put that out there for the last 20 years, like it's nuts, kind of thing. So where are we standing at months of supply? Y'all know how many months of supply we need to have a balanced housing market, which means the number of buyers and the number of sellers that we have matches. How many months do we need? 6. Yep, you're exactly right. And we are at 2.4. So in FMLS, we're running 2.4. We've been, annually we're at 2 in Georgia MLS 2.4, 2.4, and for the last 3 months, 2.6 months of standing inventory. So we are still half, sitting at 3 months of standing inventory, and we need 6 months. So we don't have enough homes. We have a lot of demand that is still being pent up and held back by mortgage rates. But I want you to feel very confident that the real estate market is not going in the crapper here. That's not what we're talking about seeing. We're not seeing property values drop. So now one thing that we are seeing, so this is the median percent of original list price. We're running about 98% of list price. So we're down from the 100% that we've been running, which is normal, by the way. But what does that really tell us though? We have a lot of homes that are overpriced. We're starting to see where the sellers are having to be realistic about pricing, and that we need to be doing a really good job of trying to use our numbers and our comps to help our sellers understand that. These next 2 slides, I want you to really kind of notice on here what's going on. And so these are for our active listings out there. And so you can see that for our active listings, first of all, what I find very, very interesting is that active listings are really, really consistent across all price points up until you get to about $1 million. Until you get up to $1 million, our days on market are really pretty similar. They start moving up once we hit that $800,000 range kind of thing. And it really increases after that. You can see our average days on market is only about 45 days for all active listings. How about for properties that sold though? 20 days, 21 days. 21 days is the average of all our sold listings. So for all the sold listings, they went under contract within 3 weeks. That's your benchmark. Like that's the number that you got to understand. If you're not under contract, and I mean under contract within 21 days, then you're probably overpriced, right? This comes down to price versus condition. And so those are your numbers. Like if you're not under contract within 21 days, you're probably overpriced for where the market is right now. And we're not looking at property values declining. What we're looking at is we're not looking at the rate of appreciation being as high as it was before. And so folks still think, hey, it's still and when you look at it, is this still a seller's market? Yeah, it's still a seller's market. As crazy as that sounds, it's still based on supply versus demand. So we still have a heavy seller's market at the moment, and it's kind of running across a lot more. We kind of expected a lot more pressure on the lower, on anything under 250, anything under 300 kind of thing, but we're seeing it across the board. I mean, our actual lowest average days on market on sold properties is actually $300,000 to $350,000. That is the shortest amount of time on there. So anytime that things are uncertain, that's when people want to jump back, kind of thing. They just want to sit on the sidelines, wait things out. But I want you to see this is data that was pulled today, this week, like really recent data, and be able to clearly be able to share that around. One other concern that we had earlier this year, the first and second quarter of the year, we had 2 consecutive quarters where GDP dropped, which is normally indicative of a recession. And I'm not worried about a recession, honestly, because a recession, a lot of people take that recession word to mean that that a recession is going to affect housing. And I'll show you in a minute. Recessions don't necessarily affect housing. What we kind of have to understand is that we just got the third quarter GDP numbers in, and they were actually really, really good, 2.6% up. And so we didn't have a third quarter of negative GDP, but that was driven by imports and what we shipped out. I think that we're going to, with what the Fed is doing, I really do see that moving forward, we may move into a recession, for the fourth quarter of this year. That may be the case. I'm not worried about it being a recession, but we have to understand that's something that can be out there. And so, the Wall Street Journal went out and polled all these different economists and said, hey, what are the chances of moving into recession over the next year? It's pretty high that we will. And so, as such, 3/4 of Americans are taking steps now to hedge that. They understand that that's kind of going forward. So people are trying to prepare for that. Some folks are delaying major purchases, like say homes, cars, paying down debt. Almost 30% of folks are planning on reducing their holiday spending. I'm expecting holiday sales to be really, really down this year. However, if there is a recession, this is what's happened on the last 6 recessions that we had in the United States. What did y'all notice? Property values go up. I mean, now in 2008, who was the cause of the recession in 2008? We were. No. We were all Oprah Winfrey real estate, right? Like you get a house, and you get a house. If you get a pulse, we'll get you a house too, kind of thing. We had stated income. We had, like all these crazy things going on. So, looking back, like we were part of the problem then. But if you look, just because it's a recession, does that mean that housing goes to pot? No. This is what happens with property values, and all those dark bars. Those are the recessions. What do you notice about property values? All except for 2008. So I'm not like, oh no, recession. Like I'm not saying, and I'm not hoping bad economic activity for Americans. That's not what I'm saying. I'm just saying that having a recession does not equal a housing crisis, and that's what we have to understand. However, every time there is a recession, what happens to interest rates? So I'm not saying that that's a silver lining, but we already, like I see interest rates going down. Several of the other folks see interest rates going down. if we do move into more likely of a recessionary type of environment, I feel that the Fed is kind of pushing us that way a little bit right now. They're trying to slow the economy down. And so when that happens, what happens with interest rates? And then what happens when those interest rates come down? I mean, we see that there's a huge pent up demand. There's this massive buyer group ready to buy. There's folks that want to buy. And so, like there's the floodgates waiting to rush open is what I'm saying. So I am not apprehensive about housing moving forward. And I don't think you should be either. So these are the house pricing forecasts for 2023 kind of thing. They average them all together. They're all averaging around 1.8%. Fannie's looking at 4.4. Freddie's looking at 4. The Mortgage Bankers Association thinks it's going to be closer to 3. NAR's at 1.2. Only Zelman is predicting a property value decline kind of thing. This is the number of cities that are forecast to have price reductions or not just price, either appreciation or depreciation. Atlanta falls in that 151 category, the 3 to 5% range. That's where the Atlanta and the Georgia area is looking to be moving forward, is somewhere in the 3 to 5% range. Now, there's a lot of these other places over here that are in red, a lot of your West Coast markets, New York, some places in Florida, things like that. Are they gonna, is the news gonna be all over those properties that
Yes.
yeah, absolutely. You gotta be ready for that. Just because property values are dropping in, yeah, in San Francisco, does that mean that's happening here in Georgia? No. So we're actually in really, really good shape when it comes to that. We don't have, we have a huge net inflow of people moving to Georgia from other states. New York's the number one where people move here to. We have a much lower cost of living than other places in the United States. So, and then this is, just on the number of analysts, the talking heads, the gurus out there who are predicting appreciation and depreciation. Yes, there's some people who are predicting, like markets going down. The vast majority of people are saying markets continuing to go up. This is the forecast for 2024 through 2026 kind of thing. Roughly 90, 95% and 85% of folks say over the next 3 years, over the next 4 years, or 3 years after what's happening with property values, continuing to move up. And so to take this conversation back to our very beginning, when we said, if I'm going to rent, and I'm going to rent for the next 5 years, or I'm going to buy for the next 5 years, what are property values looking to do for the next 5 years? Continue to go up, even if they just go up at historical norms. Even if we'll only run 3 to 5% property value increases, by the way, which is normal. In 5 years, how much equity do you have? 22% property value, growth, equity that's grown in your home, as opposed to staying that renter. So, So this is CoreLogic. And so CoreLogic is probably one of the biggest data people out there. They're plugged into most of the MLSs inside the United States, get their data. And so they're pulling actual MLS data all the time. And so they're looking at right now in the US, property value increases are 11.4%. And they're predicting that next year, 3.9, which is right in line with exactly what we're talking about doing. So now I was talking about this earlier. And so there are still some cities with huge month over month gains. Look at Miami, 25% up kind of thing. Now, the old adage of what goes up must come down. If it goes up really fast, is there a chance for it to go down really fast too? Yes. Did we go up really fast?
No.
You can say yes. When you compare us to the rest of the country, we went up very moderately. So we're not on one of these places that is like top markets at risk of a home price reduction. Guess what? There's not a city in Georgia on this list. So
It seemed like a lot of folks moved to Florida after the COVID.
they did. Yeah. Wanted to be where it was warm, kill the virus, right? I'm not sure how great that worked. One other thing I want you to look at, is this is the percentage of properties that are distressed. are we heading back into another market like 2008? No, we're not. Look at where we are on the total number of foreclosures that we have. Lowest we've ever been, right? So right now, there's only about 214,000 homeowners across the US facing possible foreclosure. Of those, 91% have equity, which means they don't need to get foreclosed on. What do they need to do? Sell. So, and like moving forward, if we are in a recession, if we do go into a recession, if things are tough economically, will there be folks that need to sell? Absolutely. Will they like it? No, but they can't do a short sale because their home is worth more than what they owe on. So they can sell and capture that equity. I'm not saying that they want to sell. I'm not saying that they're like, where will I go? I understand those issues, but can they sell and still capture that equity? Yes. So we're only talking about 9% of only, those 214 people that really are at risk of true foreclosure, which is like a drop in the bucket kind of thing. So I want to switch gears here a little bit and talk about video for a quick second, because video is a really big deal. And I love y'all, but a lot of y'all are cowards and you need to do more video. So I want to kind of talk about, like how do you do video? How do you do effective video? Because what I'd like for you to be able to have is a tool that you can use moving forward with your clients. And so, video is now the most consumed digital content type online. So whether you're talking social media, anything online, what's the number one content out there? Video. Facebook and Instagram algorithms boost video. So if you do video, they're going to reward you by that post going out into more places. 81% of consumers make buying choices after watching video. So is this a good place for us to be? Absolutely. So let's talk about how do you do video. So first thing is you want to start with some kind of a hook. You got 3 seconds, right? First 3 seconds are key for people, because after 3 seconds, they're going to decide either I'll watch more or do I turn you off? So you got 3 seconds. Give them a reason to watch. Don't give them your name. I know that sounds weird. I'm not saying that you shouldn't introduce yourself, but you need to set your hook first, right? So you don't want to do weird pauses. You don't want to give your name. Hey, I'm Alan. Don't care. Start off with a reason. Tell a story. Ask a question. What works really good is if you can ask a question that is a pain point for one of your clients, because it helps you attract yourself to the people that you really want to work with. The next one is support it with data. Share the information that really makes sense. I gave you guys, or I'm going to give you, I don't know, there's about 60 slides in this, in this slide deck that are available to you guys if you don't want to. And you can go dig up so much more information if you want to go get that information yourself. But there's a lot of places where you can go and get data. So use pictures, add in other, graphics, images, that kind of stuff. Don't try and talk about it because people can't visualize it that way. Put the thing up there, make yourself small, like switch to that type of video, that kind of stuff. Use visuals in there. And then the last step is then it's the connect the dots. This is the wrap up. So like, here's the problem, here's the data, here's my take on it, that kind of stuff. Explaining, like I'm not trying to mansplain things, but you want to explain kind of like here's your problem, here's the data, here's the solution kind of stuff. This also helps you put yourself as being the expert for everything going out there. And so that's 3 of the keys to communicating with real impact. Because, and one of the reasons I wanted to give this to you, because what I really want to wrap up with is, when if you look at those headlines I showed you guys earlier, like I don't worry just about the consumers, our clients looking at that. I worry about you guys looking at that. Because when you look at that, it affects your psyche too.
Yeah.
And then it also affects how you go into your day. It affects how you look at the business. It affects that, as to what you do to go out and build your businesses. You're all small business people. You own your own business. We're blessed to have you hang your license with us. And I really do appreciate that. But at the end of the day, if you get depressed and you say, you know what, business stinks, market's uncertain, I'm just going to, revert to my shell. If I'm just going to sit back here, I don't know what to do, so I'm not going to do anything. Is that good for you? No, it really, I mean, it's really, really detrimental to your success. So I need you to be able to talk yourself into understanding what's really going. Now is the time to build relationships. Now is the time to reach out and engage with your folks. We know that lower interest rates look like they're really heading this way. I feel very confident about in the future, they are coming that way. We have some different options for what's going on. This time of year, though, there's a lot of folks who don't list their properties during the holidays. There's a lot of folks who don't look for properties during the holidays. And now we normally see that starting January 1, we start blowing it up. Now, those transactions don't close until February and that kind of stuff. That's why we start seeing that market change. February, March is normally really, really good times. But all that starts on January 1. But those transactions in January 1 come from relationships right now. Okay. And so if you get yourself into this funk, if you get yourself into like business stinks, I shouldn't do this, I'm going to withdraw, I'm not going to engage, you're kicking, you are literally throat punching yourself. Now is the time to double your engagement. Reach out, be the expert, do video, share these kind of things out with everybody that become known as being the educator, be the voice of reason, help folks out. So I hope this was helpful. I really appreciate you guys. I did want to kind of close today with congratulations to our top producers kind of thing. Overall, Shannon Bobby Kirk, Brian Meckling, David is number 3 kind of thing, that kind of stuff. Darla, Carlos, Janice, Ashley, and Yolanda, those are our top sales folks in the company. And so I appreciate you guys. We're going to go to the local one. Thank you guys very, very much. All these slides will be available to the branch managers here in just a few minutes. And I love and appreciate y'all. Thank you very much.